they need investment banker, they need underwriter who can underwrite their business, they need a merchant banker who can arrange the liquidity throughout this process if you need any cash payment, because during the merger and acquisition process they cannot use their cash balances and all, so they actually access the you know or arrange the credit line, because uh, accounting teams basically will have to do the accounting of each item to compute the value of a business, means real value of a business as per books like balance sheets and P&L, and then only they can come at the point where the accountant or financial modeling team, they can advise or consult on per share price, like what could be the per share price on the basis of balance sheets and all. So it means during this process they need a support from basically investment bank like JP Morgan, Goldman Sachs, Kotak, HDFC, or even merchant banks as well, like who are into the merchant banking. It means will provide that liquidities or mezzanine financing support during this process. They need those banks as well. Apart from this, the investment banks, they provide underwriting service. Underwriting service, it means the valuation service. So they'll help to uh, value the business, calculate, or I would say like calculate the fair value of business or fair value of per share price. See, nobody merge the business with the market value. So which is, let's say, the price which you see it on stock exchange, that price which is not the real price. So businesses always uh, compute the actual value. Actual value, it means as per the balance sheets, how much how much is the liability or how much is the assets in the the balance sheets of a company. On the basis of, they actually calculate the value of the business, and then they merge businesses. Because merging, it means, see, there are types of mergers. One is just the normal partnership. So it means only the name or resources they can share, but the financial part, everything would be separate from each other. So that merger and acquisition, you can call it as just the collaboration. There would be another merger which is something, the both the entities just want to tie a knot and work together as a one. So for example, let's say HDFC and HDFC Bank Limited. So HDFC Limited and HDFC Bank, now they have merged as HDFC Bank only. So we have now HDFC Bank Limited at the moment. But now, means post merger, only the both the entities, they are working as a HDFC Limited. So HDFC Bank Limited, and now the HDFC Limited, which has been disposed from the market. You cannot see as even shares which are uh, means which are not in the market. Only the shares value which has been adjusted, and it is there in the stock market only at the moment, which is HDFC Bank. So there are types of mergers. See, first, merger and acquisition decision would be based on the founder or promoters of the business. They'll decide what to do, what not to do, and why they want to do it. If they want to do it, they'll do it. If they don't want to do it, they'll not do it. It's not something, it's a legal obligation, where they need to just enter in merger and acquisition. But merger and acquisition, if you ask me, merger and acquisition, which is like, the arranged marriage, or even sometime in some cases I would say even love marriage as well, where they actually come together and sign a contract, and they announce it, we want to tie a knot and live together. This is what merger and acquisition is all about. But in a finance term, when we say, if the both the entities, if they're collaborating, they maybe collaborate for a different reason. So as I said, in both the cases, if you see ABCD company or XYZ company, all they have a different purposes, and that's what they want to live together. But apart from this, they also share finances as well. Let's say, uh, we'll just prepare a simple balance sheet. Assets, 1 lakh USD. liability, let's say 20,000. Share capital, let's say, which is 80,000. And per share price, if you just calculate it, assume it, so total outstanding shares, the quantity which this company has in market, like 1,000. So per share price, let's calculate it. So share capital around 80,000 divided with 1,000, so 80 rupees as per balance sheet. So on other hand, so company B, if we look at this one, let's say this is a startup company, they have liability like around 2,000, capital is 8,000, and total number of shares they have again 1,000 shares with 8 rupees per share price. See, now in this case, both companies want to tie a knot, and they want to tie a knot which is a strong knot, like want to leave it together under one name, and they want to merge their business, their everything. Okay, they want to merge with everything. Then what about name? It could be different, but what I have seen, like the big companies, if the company is really, it's a, let's say, which is a famous, and for example, let's say Tata Group, they don't change the name because they're very famous. Reliance Group, they don't change the name. For example, let's say in case of Reliance and, sorry, Geo Finance and BlackRock, they have signed, the merger and acquisition for India for a mutual fund business, right? But still, they'll operate business under Geo BlackRock partnership. So it means they can, name to their newly marriage like Geo and BlackRock partnership or LLP. That's how they'll come up with the name, because both are now in this case famous. But if any famous company, if they acquire to the small ones, so the famous company will say that, look, I'll operate under my name. And that's what I said. If any business, if that want, let's say, brand or, liquidity, market share, leadership, guidance, or access to the large client pools, then they join the the big companies. So that's how you can see merger and acquisition. Now, if we talk about, how this game work out, see, both the companies, they hire to, as I said, investment banks, merchant banks, even banks, normal banks, to manage cash transaction, uh, then depositories, and even financial modeler or underwriter. And in this case, they need a consulting firm as well. Consulting firm like BlackRock, they need it. Why they need it? Because consulting firm like Big Four will audit the financial statements or identify some, gaps, provide feedback, even guide on risk, probable risk, along with this merger and acquisition. And see, everyone need a consulting as well. The way doctors provide, their prescription to the patient, like how to, let's say, take care of disease or so and so forth. In the same way, the form, like, the big four like KPMG or PwC, Deloitte, they advise to the companies whether they should go ahead with merger and acquisition or not, or even, during the merger and acquisition process, they work as a consultant, take care of financial reportings or auditings, uh, then highlight some red flags along with it. So this is how, see, basically every participant has a different rules in this process. Every, it means every, they see how they can contribute to this merger and acquisition to make it this deal happen. It's a deal process actually for them. For investment banks, it's a deal. Merger and acquisition, it's a deal. Oops. See, now if we talk about, let's say, they have higher bankers and financial modeling, experts, underwriters, and they all have come up with, the data like clean and neat data, which is assets, liabilities, share capital, and total shares, which is all about this. See, market price of both the companies, it could be different, and that won't impact on merger and acquisition deal actually. The reason is market value of shares, which is a inflated price or could be deflated price. But on the ground, let's say they have a cash, they have assets or liquidity and everything. So that game would be different. And merger and acquisition, basically, the base would be your balance sheets or book values of companies, not the market value. Nobody is going to, let's say, sign you contract with the market value. Both the companies, they decide or put a base, like, their actual balances. For example, let's take it in a different way. Let's say you and I, we both want to start, real estate business, right? Then you have, means we have agreed to contribute 5 lakhs each. Means I'll contribute 5 lakhs, you'll contribute 5 lakhs. Then that partnership valuation would be 10 lakhs, correct? But what if, let's say, I have a 1 crore total, my wealth is 1 crore, you have also 1 crore, your total wealth is 1 crore, but out of that you have just contributed 5 lakhs. So that doesn't mean, your new partnership will have a valuation of uh, 2 crores. No, because we have contributed only 5 lakhs. So business valuation would be 5 lakhs. So what it means, market value, which is an inflated value, we don't need to consider that value. So we just need to consider value of businesses on the basis of their financial statements, and that's what we need. This consulting firms and other, the financial modelers to underwrite this business and build, financial models to take the decisions whether we should go ahead with the merger and acquisition or not, what would be the per share price, the impact, the possible, the risk along with it. And that's how, financial modeling experts or analysts, they contribute to build financial models. And they need a extensive data like last 5 years revenue, expenses, income, assets, liabilities, movements, or they refer lots of, different inputs, and accordingly they just build financial models and come to an, agreement where what could be the per share price for both the companies. But uh, see, this is the now if you look at the situation, it's a, this portion is pre-merger situation or pre-marriage situation, pre-merger. Now, if I talk about post-merger, means how it looks like, what would be the allocation of, per share price, how investors will receive shares, what will be the impact, that all you need to do it post-merger analysis. So post merger, there would be only one balance sheet. Name it could be, let's say ABCD only. ABCD Tech want to just operate the business under their name, or it could be like ABCD Tech AI, so and so. They'll come up with this. Then the asset size would be double. Sorry, not double, my bad. Will increase. Liability size will increase. Share capital for per, share capital of the business will increase post merger. Per share price, it may impact. Let's say now asset would be like this, uh, 1,10,000, that would be the assets. Then liability, 22,000, 2,000s will add it. Share capital would be like this. And what about number of shares? Here you will have two options. One, you can increase the number of shares as per the requirement. That is one option. Second, you can increase or decrease the per share price to adjust that, the merger impact. All right. Or else third thing would be, forget about per share price, what you had with a let's say ABCD Tech, or maybe new company that you have merger and acquisition or acquired. Forget about that. So let's come up with different per share price. So how you can come up with that? Simply you just need to divide, like share capital divide with 1,000 shares, maybe 2,000 shares. Let's say in this case we have decided to go ahead with uh, 8,800 shares. So per share price would be how much? Where is my mobile phone? Let me do a calculation quick.
100.
100
Sure.
charger. So new share price would be 100 for per share. So that share price companies will allocate. But if you see, if the face value changes, then entire thing changes, like your share certificate. Then you will have to print new shares for your shareholders. All right. Then new shares will receive the shares on the basis of the pre-acquisition or pre M&A activity. For example, let's assume it. Uh, Here with this company, there were two investors. One is A, another one is B, and they were holding entire company. Uh, I think 1,000. And this guy was holding 500 shares, and this one also 500 shares, and the price was, let's say, 80. So total 40,000 and 40,000. With this company, there are two other investors, it could be C and D. They're holding, see, percentage it could be different, right? But just for understanding, we'll keep it equal percentage of share, 500, 500, with the price of 8, equal price. Okay. So now, post merger, what will happen? This is the situation of pre merger. So it means in a pre merger condition, they have their share allocation in their demat account with 500 rupees per share. So it means it is their value of investment. But post merger, it should not impact on their value. See, if I'll participate in merger and acquisition, my, let's say I'm a A, my value of investment, let's say 40,000, it should not change post merger. That's how financial modeling analyst will have to decide that part. So investors value, it should not impact. If, let's say, if impact, then investors, they'll not participate it, they'll not allow it. See, if I have contributed 40,000 and post merger, what if my value would be around 20,000? Why? Because let's say there are four partners and we have decided to allocate new shares equally amongst all four, then I'll not participate. I'll knock the door of SEBI and I'll take back up. Means, I'll just quit this merger and acquisition deal. As an investor, I'll have full rights to protect my rights. I cannot. And that's what merger and acquisition, it's a part of corporate action, and this corporate action which comes under mandatory. So it means it will not impact on investors' share value. Huh? But maybe post listing of shares in the market, you might see some negative impact on share price due to number of shares, high supply of shares, or negative sentiments. Because see, market experts, they always give a gyan on different things, so that might impact. But that is not something which comes under your merger and acquisition, underwriting process. Because in underwriting process, what we do, we build a model which will ensure the equal allocation of shares. Equal, it means on the basis of their investments, and the reference would be their previous investments or pre-corporate actions, or I would say pre-merger, value. So this value, we'll call it as a book value. So we'll refer this book value to allocate the shares. Okay, right. Oops. What happened? All right. So now, then, in this case, if we see, we have increased number of shares and reduced the per shares price. Then how we can allocate the equal amount of shares? Okay, how we can allocate? Let's see, let's figure it out. Let me do some calculations and then I'll guide you. 1110, sorry, not 1110, 8888 divide with 8800. So I think we have wrongly computed. The price would be 10 for
10
purchase.
only.
10 for
10.
purchase.
Yeah.
Yes.
It's my mistake, sir.
You know, is that's what I mean, thinking. Something wrong ho gaya hai, but no worries. So 10 now we have a shares per share. See, before this means before or in a pre-merger stage, per share price was different, right? For this XYZ Tech price was 8 rupees for per shares, and for this ABCD Tech price, which was 80 rupees per shares. But now the in a financial model we have come to an agreement with different price, which is 10 rupees per shares. Why? Because we want to ensure the equal allocations of shares, and which will not impact on uh, their the actual book value of investments which they have made with their companies in the pre-merger stage. Okay. Now, so how we can do allocation? Let's compute it. So 40,000 of investments of A, and again 40 of B. So, and you have a per share price. Simply just multiply, not multiply. So divide 40,000 with 10, which is per share price. So you will receive
Yes, sir.
quantity of around 4,000, and new allocation would be 4,000 shares at price of 10. 4,000 shares, price of 10. Do the same thing for this one as well. The investors are different. New shares should be 400 at price of 10. And this is how you, if you see, means even after merger and acquisition, there is no change on their holding. This would be new allocation of shares with different price. And finally, this share price they can list, or they can ask depositories like NSDL or CDSL, to print out, because printing of shares is also important, along with the new face value will change in this case, right? New face value, it could be, let's say, 10 rupees per shares, or 1 rupees per shares. So depends how they want to keep it the face value, because it's a regulatory requirement, so they'll have to come up with face value, they'll have to come up with book value, but this is the book value. And market value, it could be different, because always, what I have seen, like, market value either could be, let's say, inflated or deflated, so depends. All right, because that is something which is a part of market sentiments, how the investors will treat, how the experts will conclude this entire deal process. Because experts always count, the future threat, opportunities, expected revenue, right? Then market share, and what to do the actual value addition post this merger and acquisition. If there is no value addition, then you won't see any appreciation in price. Because I'll tell you one more example. Go to the this company, Atos. Is anyone here from Atos, Sintel? I think this company has acquired someone and relisted shares. This is what the there is a change in share price, but 1 month, but still which is not performing well. So it's a sad part. Share price it was at, oh, good news. In September they have posted positive net income which has been increased directly by 1 billion. How it is possible? Interesting. See, this company has acquired Sintel, as we means you would have heard about it. That this Atos group has had acquired Sintel, but before that they had acquired around 20 to 24 companies. So it means if you go and check their history, continuously they have acquired companies. Uh, if you just go to the Atos official side, Atos. Uh, Official site. This is one of the largest French company, and they are into cloud and infrastructure and all of this. If you just go to their sites and try to look at the business model, mm, partner and channels, financial restructure, investors, shares, regulations, inside Atos ISM finances, EI driven, not secret. Why? There was, I mean, structure provided, but not sure where now at the moment. Let me just look at Atos acquisition and history. Leave it. So here basically, that Atos company continuously acquired entities, one after another. And what happened when they acquired Centel, their liquidity dried out. They purchased directly Sintel with a cost of 22,000 crores, but they actually Sintel company was a loss-making company, but they had a good infrastructure. That's what they wanted to, they access the infrastructure and everything, and they purchase it. But then after, what happened? Suddenly, the downfall started for Atos. When they acquired Sintel at that time, the share price was around 134 euros. But within 4 to 5 years, back to back, the share price, it was declining like year on year basis, and it was reached to the 0.001 rupees something, and I think they have delisted and then released the shares with a different price. That's what they did it, and that's what now if you see the share price looks like, which is at 34, but which is not actual 34. So they have consolidated. It means they have scheduled reverse stock split, consolidation of shares, and released with a new price. So that will give a feel to the investors. Okay, so look, my share price, which is not zero, which is something, let's say 30, 40 rupees, but that again won't impact on your investments. Anyways, your investment is investment value has been reduced, so definitely you would see that impact as well. So point here is, see, post merger and acquisition, which is not necessary that every time investors will take it very positive to you, and uh, you can see good let's say improvement in share price. No, this is, see, this is something I would say, how experts will take it to the this merger and acquisition or new marriage. It's completely different game. They'll have certain parameters to evaluate. They'll have certain techniques to see. They'll have some certain expectations out of this, because just think in a very practical way as an investor. Before merger, share price or investment value was 40,000, and even after, let's say, post merger, there is no change in investors investment, right? There is no any change at the moment, but let's say after 1 year, what investor want from this post merger? Growth in revenue, growth in profit, growth in client base, reduce in cost, robust infrastructure. They want it, right? So see, basically share price is based on, share price which is based on certain parameters. And what are those parameters? Certain parameters, it means revenue, net profit. What if, let's say, there is no change in the asset? And when there will be a change? Of course, when you earn profit, asset will appreciate. What if post merger, that company management, they have some conflicts and now they are not able to scale or let's say multiply their revenue? Then definitely you would see decrease in share price, right, from 10 rupees to maybe 5 or 2 or 1, depends. So it's not necessary that every marriage will become successful, right? So they might take even divorce as well, like through demerger strategy. Maybe they can announce demerger, we want to demerge the business, don't want to continue with it. There are lots of strategies. Okay, we you would have seen the demerger of, let's say, this Geo Finance from the Reliance Group. Why? Because they wanted to focus on finance. They just demerged it from the Reliance Group. You might see that as well. So if you ask me the now difference between merger and demerger, demerger it's like a divorce. You're taking divorce from your husband or wife. Why? Because there could be two reasons. One, like you both have decided, it's a willful decision that you don't want to stay together. You're looking for a new partner. You can, I mean, go to the court, file case, and separate it out. You can even have a distribution of assets as well. Depends on the your mutual agreement. How partners you want. Maybe you can file some legal petition as well if you're not happy with alumni or benefits or asset distribution and so on and so forth. And the one more part, which is, let's say you guys have always conflicts and you don't want to continue. So that's the, you can say, forcefully you're taking divorce. You want to willing to work with, but due to just conflict, you have decided to just separate it out. See, same method, apply it in demerger process. Merger, again, it's the same. If you like each other, you come together and you tie knot. Same thing happened in business also. If both businesses and promoters, if they want to, let's say, collaborate on technology or capital and so on and so forth, they come together, they tie a knot, they sign paperwork and issue new shares, right? And they continue with their like new business. Newlyweds sansar. But as we know, in a personal life also, there would be, lots of ups and downs. We cannot surely tell whether we can, will hold the hands of partners, uh, let's say, till last breath of your life. We can't tell because there are lots of, circumstances or situations. So same way, If any business, let's say, is now going to get, married together or merge with each other, so that doesn't mean it would be like long lasting marriage or long lasting M&A, merger and acquisition. Merger and acquisition, it's a part of business strategy. If the strategy objective fulfills, they may go for diversion or demerger. For example, let's say Hero and Honda. What happened in their case? The Hero company, which is not from India, I think, but they and Honda is from India. I'll have to check that in exact details, but I know the story. I'll tell you. Uh, Hero and Honda. Let's assume it Honda was from India and Hero is from the different country like Japan. But that company want to enter in Indian market and capture the market, reach to the broader audience. They wanted even manufacturing facility, right? See, if you have, let's say, car company and you are from US, you don't need to come to you don't need to, let's say, set up your fully that manufacturing unit in India. What you can do, simply you can find out manufacturer like Tata Motors, like Mahindra, like General Motors, and you can sign contract with them. You can merge your business with them for manufacturing. So it means Tata company will manufacture your cars on under your brand name, and you can sell it out in market. So it means you can focus on selling. Tata Motors will focus on manufacturing. They'll manufacture cars as per your orders, and that's how you can operate your business. But what if, let's say, you have a conflicts in between? They'll not manufacture cars. They'll simply drop this agreement, or and they'll demerge from you. You get it, my point? So same thing happened with Hero Honda as well. So now Hero and Honda, now they are two different entities. They are not together. They are not together. They have separated. They demerged from each other. Why? Because it was a strategic decision where they wanted to capture the market. They captured it. And finally, once the objective has been fulfilled, they decided to demerge from each other and operate the sole entity, and now they're operating. But in a demerger process, guys, how would be the share allocation? That would be, see, in that case, then the shareholders will receive option first, options, or they'll schedule elections and they'll ask or request shareholders to choose whether they want share allocation of both the entities, means Hero and Honda, as per the example, or let's say they want to go ahead with Honda only or Hero only. So accordingly, you'll have to build a model. So see, model building, it's not an easy process. For building a model, we need a data, and without data, we cannot build a model. We'll have to understand ground level reality, what shareholders wanted, what are their expectations. Sometimes shareholders, they'll simply ask for a cash, so you'll have to even redeem shares as well accordingly and resell out shares to the different investors or new investors. There would be lots of different situations at a ground level that happened. So I hope you get it. So it means, if I talk about now, if I just summarize merger and demerger process. Merger, it means two entities come together and operate business, and demerger, it means if, let's say, they don't want to continue, or if they have any conflicts, or willfully if they want to get separate from each other and operate as a individual entity, they can. But base should be balance it only, and that's what financial data becomes very crucial to take merger and acquisition decisions, or a demerger decisions, or any kind of corporate action decisions, because it's all about finance. They'll see how much would be an impact on financial statement, and that's what. See, everything is all about finance. Why we are doing business? Because of finance only. Why we are investing? Why? Because of finance only, or investments, or appreciation in value and all of this. But again, it's all about finance. For investors, what matters? The appreciation in value should not negative impact on investments. For entrepreneurs, same. They want to capture market. They want to scale business to the next level. They want to access technology. They want to also generate revenue so that they can earn more profit as a dividend. So means all stakeholders, they have their own objectives, and if they feel their objective is not, or going to achieve from this partnership, that's when your demerger come into picture. right? But in this case, guys, if we see, we have a, the share allocation, and that we have allocated, and this would be your post merger activity, and they'll finally confirm it, okay, the merger which has been done. And this, shares, basically we need a depository, as I said, NSDL or CDSL. That depository will remove this old shares. This becomes old now, and new shares will be allocated. And this would be, clearly this would be like equity swap. Like old exchanged for new. So it's a swap basically. So shares will exchange, and new shares will be credited to the investors. But basically, we need a depository in this process to take care of it. So who take care of it then? NSDL,
Yeah.
CDSL, and they'll arrange the facility to uh, oops, debit or credit new shares to the investors. Because at the end, shares will be credited or will be debited from the demat account, right? It's a inventory. Shares, it means it's just an inventory. Did you get this? It's just an inventory. And that inventory movement is also necessary in the merger and acquisition process. So new shares will be credited with a different face value. Even CDSL or NSDL, they print out. Who print out the shares? ABCD, Tech AI. Common shares. There are types of shares. Let's say face value is 1 rupees. So this becomes your new shares, and CDSL will basically issue the shares, and that, will receive in the demat account. And this is would be new print altogether. So that newly printed shares will now issue to the investors, and same name you can see, it will reflect on NSE and BSE site as well as ABCD Tech shares. And old shares of these two companies, mm, ABCD Tech and XYZ AI. XYZ AI. So there's two companies shares. It will dispose automatically. What is it? So this will dispose. So old shares will dispose, new shares will issue to the investors. So this is how basically, see, there would be lots of things involved in due diligence process, KYC or uh, banking check, wire payments, and all of this, right? That you will have to take care of it. But this is what something, that the interviewer will also expect it, so that you should know at the flow, what will happen, and so on and so forth, what exactly happened, so that you should know it. But how? See, from the investing point, if we try to look at, and if we try to, let's say, see some ratios how this will impact on investment. All right. So the first ratio that you can maybe, let's say, post merger, uh, that the newly means wed entity announced quarterly result, and in quarterly result what happened, uh, this new company posted profit, profit of uh, 1,000 rupees, sorry, 10,000. And let's say before this, quarterly profit posted same, and here let's say they have posted number like this. Posted profit is, in quarterly result they have posted 11,000 as a net profit, and before this it was, just assume it, okay, we haven't included in the model before this, but we just wanted to, I just wanted to make you understand how things changes means post merger also, and how investors look at to this situation. Profit post merger, it was 10,000 for tech company and 1,000 for AI company. If you just calculate the earning for per shares, how we calculate it? Profit divided with total shares. Okay, so total shares we have thousands, and the earning also we have it. So just calculate for both the companies. Can you calculate earning per shares? Quick, EPS, and tell me a number. I'll just write the formula.
Divided by
Profit divided with total units. How much?
10 rupees
10
for
rupees
investors.
per share, not invested. Total shares are 1,000, right? In this case.
Yeah.
And here, if you calculate it, per share price would be number of shares which are same. So it means 1 rupees
1 rupee.
per share. And post merger, we have a situation, number of shares which are, come on,
8,000.
8,000. So just calculate it, 8,000, 11,000 divided with 8,800. Quick. Calculate and let me know.
13.7. 11,000 divided by 8. Sorry. 1.37, sir.
1.25.
37.
1.25. That would be per share price. 11,000 divided with 8,800.
8,800. Okay. 1.25.
1.25 rupees for per share.
Yeah.
Look at this. Earning per shares, technically, if you see earning per shares which has been diluted or depreciated, decreased, am I right?
Yeah.
Earning per which has been decreased. But anyways, you have means, if I talk about, see, investor E will calculate how, I'll tell you this one. Investor A will calculate it. Okay, I'm holding 4,000 shares. So calculate it, 4,000 into
1.25.
1.25, which is 5,000.
5,000.
And again, that same investor will calculate the means the merger acquisition earning potential. Let's say into 500.
5,000.
5,000, and same will be for across all investors anyways, so I don't want to calculate for every investors. So now
Same.
look at this. If there is no and in this case again go and check, there won't be any big movement in share price in the market as well, because market share price base would be your balance sheet. Okay, sometime you might see shares price which has been pumped by the so-called uh, freaking that HNI investors or hedge funds, you might see that, but actual value would be based on your balance sheet, and that's what we calculate intrinsic value in, when we take investment decisions we always look for intrinsic value. Intrinsic value, it means fair value. Fair means it's the actual value. So let's say how much the assets and liabilities or income and expenses which are reported in the balance sheets, we go as per that only. Means cognizant investors, they always take a informed investment decisions, and novice or newly means new investors, they don't look for any data as such. What they look for, news, tips, and they just simply put money in risk. I don't want to means go into this trading and investing part, but this is what things happened. But if I talk about, let's say, professional investors or entities, how they look for this one, okay, they'll just compare it. Before the merger and acquisition, my total earning means earning per shares was 5,000.
Same.
Post merger and acquisition, again earning for per shares is same. Then from this point they'll actively keep an eye on movement of a company. Same thing happened if, let's say, again at the same quarter, you can go and check most of the HNI investors, not retail investor, because they don't know what to check and how to check, but the retail the HNI investors or big investors, they start trimming their portfolio. So it means you can see that this company has sold, or investor has sold shares from this company or that company. Why? Because if there is no improvement in, let's say, earning per shares, then you will not see any improvement in stock price, except penny stocks, because for penny stocks we don't check, we means there won't be any perfect logic. It's all about hype or manipulations and all, on the basis of that shares price actually inflate or deflate. Forget about that. But if we talk about well-known reputed giants like TCS, Infosys, HDFC, or all of this, their share price would be based on a balance sheet. You might say appreciation like 30-40% higher than the balance sheets, or 50 or 100% higher than the balance sheet, which is still fine, but not like, let's say, 1,000 time higher than the balance sheet or book value and all of this. See, I always believe that book value and market value, it should be in a reasonable line. Not like, let's say, book value for per share is 100 and market value per shares is, let's say, 10,000 for per share. So what makes sense in that case? Now you tell me, what if that giant, let's say, collapsed very next morning, you got a news that company has been collapsed due to XYZ reason? Then as an investor, you cannot claim, look, I had invested 10,000 rupees for per shares, means purchase the share price shares at 10,000 rupees and invested, let's say, 1 lakh. Now I want my 1 lakh back. Nobody is going to give it to you. And that's what CB or means regulator, they always inform to us. Please be cautious. This share price and book value, both are like, both have a huge difference. Please check all the documents, or do a proper research before investing in this particular stock. If you invest in this stock, it might risky for you. You may lose your money. Why they always send notifications to us because of that only. Because as a retail investor, what we look only retail price or market price, which is not actual price. But big investors, guys, they look the book value. Then difference between book value and market value. Then improvement in you know numbers like revenue, profit. If there is no change in revenue, then what makes sense? There should means companies should post revenue, and that also it should be like in an incremental basis. If there is no growth in revenue, see share price it will not increase. If let's say XYZ company if continuously post same number same number, it means same number, let's say 10 crore 10 crore 10 crore 10 crore, you will not see any improvement in share price. Your share price will stuck somewhere. So it means share price has let's say base of your business operations activities. If the business is not able to scale or expand or generate more revenue, then it will not any change in a stock price. I'll give one more example. Let's say one of my favorite stock. This one. I think Google Finance is providing wrong data, if I'm not wrong. Look at this. In 2020, share price which was at 1.23. Okay. In 2018, share price was 0.92. And in 2024, share price which is at 68.53. And I have purchased this particular shares which is at 18 rupees something. So I'm holding just 4,000 shares. Okay. But now, if you look at the numbers, I'm interested in financial numbers. Go to the financials. Look at the income. See, in 2018 to 2021, there is no big difference in revenue. Okay. And if you go and see the chart, we haven't seen any big improvement in share price as well, because there was a loss, like continuously company was posting loss. But in 2022, suddenly company started posting positive income. Right? Company started posting positive income, and continuously, if you see, we have a numbers as well here. 2018, where is profit? We'll directly look at to the profit. Net profit. Look at this. 20 million, 28 million, then loss around 24 million, 5 million. But after 2021, company started posting positive profit like 59, 368 million, 700 million, 1 billion. Look at this. And then means stock price jump from directly 1 rupees or 2 rupees to continuously, let's say means appreciated only. So till now I would say continuously they have appreciated. So basically, so it means the market price is based on your fundamentals of company. If the fundamentals are not strong, you cannot see an improvement in stock price. If the fundamentals of a company is very strong, then you can see huge growth in stock price. But new investors or people who don't know about ABCD of stock market, what they do, they just simply go to the stock market, open the account, and purchase the shares by looking chart. Oh, looks, let's say this maybe goes in maybe in this direction or that direction, so I'll buy it. They'll not check any details as such. But I do check, not maybe full details, but at least management commentary or their numbers, how they're performing, their cash flow, whether they have a liquid cash or not. In this case, they have now free cash flow, liquid cash, but in 2020, but still, they were carrying positive cash, but in 2018 or 1920, they were facing some issues. They have improved a lot now, and they're working hard, and posting continuously, uh, positive, I would say, cash flows or profit. And one more good part which I have seen, their liability. It's a debt, I would say, it's a debt free company. So it means they don't have any debt as such. Their equity value is higher than the debt. Look at this. Equity value shareholders, which is around 6.48 billion, and long term debt, which is 154 million only. Just there means they're like they have only payables, and which is like insignificant. They can easily manage it. Look at the current liabilities, 2.3 billion, but current assets they have like 6.52 billions, which is 2 to 3 2 means 2 time higher. They have assets to cover the debt, and that's what we have seen good improvement in stock price. So this is how, see guys, means things works. See, stock price, which you look at this one, this looks on market, means market screen price, to, looks like this, means goes up, goes down, but this goes up and goes down because of company's financials. There are investors who track day-to-day performance of a company, and they try to understand how company is, uh, you know, managing cash, generating revenue, controlling expenses, how management is dealing with their challenges. They track everything and they accordingly, buy and sell the shares in the market. But in some cases, you might see actual value, as per the balance sheet, let's say actual value of a shares is very high, but in market the price of shares is low. Again, means there are, see, you would see lots of ifs and buts. The reason could be, let's say, investors, they have just completely ignored it, and maybe supply of shares is high, there is no improvement in share price, and so on and so forth. Then you will not see any benefit as such. Okay, so I hope now you get it, means market share price, how that actually works. And yeah, so continuously, then maybe there are other issues as well that you can track as an investor. You can track current liabilities or current assets. You can compare it. Current assets should be higher than the liabilities. It means companies will have to pay it, means cash will goes out from the business, and if cash goes out from the business, that will impact on liquidity of the business. So we should check that as well, like current assets should be higher than the current liabilities. In case of this example, which we have now seen for this company, look at their financials, their current liability, okay, where is the balance sheet? Current assets, they have a higher than the current liabilities, and it's a good sign. So you should check that as well, post merger also. Then total debt, long term debt, or their the assets. See, their long term debt is like very low as compared to assets. They have a huge assets around 3.4 billion, and in terms of long term debt, they have like around 150. So it means it's a almost debt free company. But what if, let's say, post merger, suddenly what we have seen, like The liabilities which has been increased could be current liabilities or long term liabilities due to XYZ reason, then it's a red flag. You should quickly try to figure it out and start trimming your portfolio or selling your securities from that company. And that's what you would see a same thing. If I talk about, let's talk about other examples so to understand in better way. HDFC Bank, which is at 2014.90, but I'm interested in financial numbers. Mm, let me go to the account and open the BSE side. Or I think on NSE side there is something called, yeah, here we go. Mm, is there HDFC Bank in this? HDFC Bank Limited. Click on bank, go to Cognisis mode. That will give you full view of companies. Okay, and look at the data. Mm, what I want, financials. Always look for a consolidated one. What you want, just click on that one. Let's say if I want to check the total profit and loss in 2020, the profit was 2 lakh 72,000 crores, and in March 24 the profit which is at 6 lakh 40,000 crores. Okay, here is the data from March to means March 20 to 24. In last 5 years, basically continuously we have seen the
Growth.
improvement or growth. But post merger, what we have seen here, guys, if you see, I think merger was happened in 2021 or 22 in between. So this change, it was, it wasn't good, because the investors, they were expecting something different, because the HDFC Bank had a different capacity. I have that open. Sorry. Uh, Let me just open that one. See, both bank, if you look at this, HDFC Bank and HDFC Limited. HDFC Limited was NBFC, and bank HDFC Bank was, bank, pure bank. Why they wanted to come together? Because of HDFC, let's say, uh, HDFC, if I talk about bank, they have a network of around 68 million customers, branches across 3,000 cities, around 6,000 branches, right? And 50% branches which are in semi-urban areas. So it means HDFC Bank has large network. And on other hand, if you talk about HDFC, uh, you know they have a different capacity altogether. So both just wanted to merge their business together, HDFC Bank and HDFC Limited. HDFC Limited wanted to even access the current accounts, uh, you know, saving account balances, FDs, RDs, even liquidity for that matter, right? And same, the HDFC Bank wanted, uh, so how they can divert their CASA amount through, or how they can, let's say, capture the other markets as well, because could be, let's say, mortgage segment, loan market segment, because NBFCs and all of that, they offer extensively the big loans to the corporates and all. This is HDFC Bank also wanted to access that exposure, and that's what they both, entities come together. But if you look at the size, it was a share swap, means investors received new shares with a different price. Okay. Uh, Now HDFC Bank, it's a completely public bank, means the promoters, they have very in very low percentage of shares in HDFC, around 3 to 4% something, not more than that, like common people. So, if you look at the chart, how market reacted post merger news, continuously market was, means shares was falling from 1700 to 1500, right? And on other hand, the HDFC shares, it was going up from you know 2100 to 2700 something. So this is what you can see, some weird trend, depends on like how investors will react to this. And post merger, what happened? See, this was the trend of post merger news, and actually what happened means post merger, what we have seen, again, share price adjusted and come down from 1600 to 1400. This is what things happened. So it means how investors will take it to this, it's a very different game. But they have improved a lot after that, and we have seen, right, in look at this here, and they have improved, means after that, if you see a jump now, profit and loss, total income or net profit from 4 lakh 41 to 680. So they have improved now, means earning per shares from 79 to 80 for per shares. But again, this is not also lucrative if you look at this, because both were like big companies, very big companies. Look at their size, how they means how they were earning like 350, then quarter 23 6 lakh 63. 2 quarters were fantastic, and then after then 2 years again, as I said, were challenging to them. But now let's see how they perform it in market. And if they perform well, definitely you would see improvement in share price. And I think they're performing, and that's what you can see. Means current share market price, which is at a very high level, like 2000, they have crossed it, and it might reach to the even 2500 as well if they post good numbers throughout this year. You might see that. uh, Profitability ratio looks good. Return on assets 21 22 it was challenging. March 23 it was shoot up, and that's when you can see change in their uh, share price as well. But in March 24 again, which the return on equity which has come down. So let's see how again market will react to this. Profitability ratio, it was good in 2020 because they were working as a sole entity like that, the HDFC Bank. But now they have merged. So profitability ratio, which is means continuously reducing. But again, this is a critical indicator, guys. We'll have to see how investors will react to this. But in a banking sector, there are other ratios as well, like NP and 8. What is that? Net performing assets.
NPA.
Yeah, NPA, which is also important to see this. How is the condition of their assets? More bad loans, it will impact on profitability of a bank. Any frauds incur, it will impact on bank's credibility. For example, let's say IndusInd Bank, they have posted 2,400 crore loss due to derivative transactions. Something happened. How it has been happened, nobody knows, but something happened, and there is a loss of 2004 crores in this quarter. And you can see stock market, the price of IndusInd Bank, which has been, uh, you know, crashed in market. Go and simply you can check the data, and then you can relate means market share price, or that screen basically, which is linked with the fundamentals of that particular company. See, price which was at 1000 but which is now at 800, but this is not the case. If you look at the actual price, it was at 1500 now, which is at 857. Why? Because of loss. Company posted loss in this quarter due to governance issue and bad accounting practices. Same thing if you go and check for Yes Bank.
So excuse me, sir. So shall we have a break for 10 minutes?
Sorry, great for 10 minutes.
Yes, sir.
Okay. Let me just finish this one. Give me. Oops. Why it is not showing? Yes, bank view. Yeah. Look at this. The share price of S Bank, it was at 381. It was one of the highly growing bank. But what happened in 2019? And then we have seen in just 1 year of time span, the stock market crash for this for bank, and price which has been, let's say, reduced from the 369 to directly, look at this, 28 or 20 rupees something. Why? Because of bad loans. So it means suddenly bank's liability was shoot up, and that's what I said. See, this chart is linked with the finance, which is the P&L or balance sheets, financial statements. If the finances they are not lucrative or good, this will definitely, you would say, the impact on chart as well. If the finances are bad, investors they'll start continuously selling the securities in market. And here same thing happened. Big investors they sold its shares, even promoters they sold its shares, and the common people they were still buying because they got to know late when the fraud actually exposed. So here promoter sold it out, then the big investor they sold it out. That's what you can see here, like big change like from 379 to 175. And here the people like us they purchased it at 175. They felt like, oh, it's a good opportunity to buy, we'll buy it. They purchase it, and then media exposed the fraud. Something happened in S Bank, and then again market crash continuously, and then the people means like us they started selling securities. But it was no use, like continuously stock hitting to the lower circuit, lower circuit, lower circuit. In just 2 weeks of time span, that stock means couldn't offer the opportunity to sell the shares because no one was buying. Everyone was looking for a selling, and this is what something happened in market, guys. So if see, financial modeling or merger and acquisition, it's not something only to collect the data and prepare a model, but it is also for like to understand the data criticality, and do a analysis or take a decision, inform investment decisions as well, or even guide to the client whether we should do it or not. This is how the financial modeling also come into picture in terms of merger and acquisition. All right, so any questions so far?
There are a lot more questions, sir. Looks like clear, sometimes confusing with the earlier session. Why we need to have merger and acquisition like partnership or, taking a franchisee, all is integrating, but we don't have that much time to ask right now.
Yeah, you can ask, that's fine.
We'll have to go through one by one again, sir.
Okay.
We need to study more.
So you had a session with me on this or with someone else?
Which one, sir?
So you said that you have
This-
lots of questions with from
No,
this.
because see, basically, if you interconnect, previous learning and now, we have a lot of questions actually. But maybe because of that, I'm not getting clarity. So I'll go one more time, and then if anything, definitely will ask you, sir.
No worries, go through it. Go through it, of course.
Please do share this one, sir. When
Let
the
me
slides.
see if I can.
Which platform are you using, sir? It's called XLE or what?
Excel Draw. I use Excel Draw. Try to access it if you can. And let me know if you're able to access it or not. Let
Yes.
me convert this into PP. Screen Mudra. Let me take a print for you if I can share with you guys. Sorry, I'm not
You
able
can
to take a
minimize.
print
And
out. Yep.
you can take a screenshot, sir.
Yeah, I mean, you guys can take it from your side. I don't want it
Sir,
because
it is very small.
take a screenshot if you want. Now take a screenshot for your reference or take a picture, which is fine.
Done, sir. Okay.
All right. So just capture this and just go through it. Maybe if you have any questions, definitely you can reach out to me. You can reach out to me directly through LinkedIn also if you have any questions or want to understand, which is fine. Okay, let's take a 10-minute break, 10 to 15 minutes. We'll connect at 11:15 then.
Okay, sir. Thank
And
you.
we'll go through the one more example which I have with me for PVR and Inox. Let's see.
Thank you, sir.
Okay.
Thank you, sir.